Good evening, everyone. Welcome. I'm Tyler Matheson.
And I'm Sue Herrera, filling in tonight for Susie Garib. Well, the day started out with a pretty pleasant surprise. The economy grew at a 4% annual rate last quarter, bouncing back nicely from the sharp winter contraction. But the fast expansion put some market watchers on edge. Could a strengthening economy force the Federal Reserve to act sooner rather than later? The prospect of higher interest rates sent stocks lower, and at the conclusion of the central bank's meeting today, few direct hints were given. Fed fatigue set in, and that sent traders to the sidelines. By the close, the Dow Industrial Average fell 32 points to 16,880. The Nasdaq, helped by those strong Twitter results, rose 20 points to 4462, and the S&P 500 had just a fractional gain. Steve Liesman has more now on today's Fed meeting and what may come next.
The Federal Reserve tapered by the expected $10 billion and brought its monthly bond purchases down to $25 billion. They had been as high as $80 billion back in December. And there was maybe a slightly hawkish tilt to the Fed's statement, certainly brought about by some of the better economic numbers we've got. Philadelphia Fed President Charles Plosser dissented, saying that he thought that the current statement did not reflect the improvement in the economic numbers. The Fed also said the likelihood of below 2% inflation had, quote, diminished somewhat, a sign that the Fed was less concerned about deflation. The Fed upgraded the characterization of the labor market, saying it had improved. The one dovish thing was the inclusion of this notion that there remains significant labor slack in the economy.
There is a tension in here, and I think the real question is this real slack? Are these workers that we can easily bring into the labor market or bring into employment without raising wages? Time will tell. And ultimately, I think that the story's been running against Janet Yellen on this for a long time. The economy is doing better, but that labor market is tightening a lot faster than she thought it would.
Second quarter GDP coming in at 4% when 3% was expected. The first quarter revised upward to a minus 2.1 from a minus 2.9%. And ADP, the private payroll company that tries to predict the jobs report on Friday, came in at 218,000, a tad below consensus, but still very strong, the fourth month above 200,000. That estimate for Friday remains 230,000.
I think what we're seeing is 5 years of hard work finally playing out. So it's more than just headwinds here. This is genuine growth. Plus, we're seeing an element of fiscal discipline coming into the U.S., which I like. But still, there's more work to be done, and I think patience is just so key here.
The jobs report and the third quarter data are now very significant. A repeat of a strong quarter like we had in the second could prompt the Fed to speed up its pace of tightening, either when it begins or how far and fast it goes when it starts. Otherwise, look for the Fed to not raise rates until mid-2015 if we stay on the current course. For Nightly Business Report, I'm Steve Liesman.
Here with perspective on what the Fed said today and what it may do and when is Alan Blinder. He's a university professor of economics and public affairs at Princeton and a former vice chair of the Federal Reserve. Professor, welcome. Good to have you with us. Before we get to the Fed, I'd like to get your reaction to the GDP report this morning, a 4% growth rate in the second quarter. Do you think that is sustainable, one, and was it, two, really boosted by a sort of snapback factor from the very weak first quarter?
I don't think it is sustainable. I don't want to sound like a naysayer because it was a good report and I was happy to see it, but I don't think it's sustainable. One, for the reason that you just mentioned, Tyler. In addition, if you look into the details, you'll see that a sizable portion of the 4%, accounting for most of the forecasters' errors, by the way, was inventory accumulation. And firms don't just keep on piling in inventories.
So what type of growth are you looking for in the near term, Professor? I mean, if the 4% is not sustainable, what would be sustainable and what would indicate to you that the economy is on a steady growth rate?
I think the two answers are the same in this case, at least for a while, which is the rest of the year sort of looks 3 to 3.5. Mm-hmm. That kind of a number. That is sustainable for a while, assuming, as Steve mentioned in the setup piece, that we still have slack in the economy, and I think we do. It's not sustainable, of course, in the long run. There's a lot of controversy right now about the long run rate of growth of the U.S. economy, but nobody thinks it's 3.25.
Let's talk a little bit about the Fed. You heard Steve Liesman say that the going consensus is that interest rates won't rise until mid-2015. Do you share that view? And what would you say to the dissenting voice on the Fed today, Mr. Plosser of Philadelphia, who seems to want rates to move up a little quicker?
So I think that Steve's estimate is a little bit long, but not very much. I'm thinking that the likelihood, if things play out as we expect them, is in the second quarter of next year. So that's not very different, but just a little different. Now, if Charlie Plosser was here, I would say, look, if the inflation rate keeps on going up and crosses 2%, and if the economy keeps on growing at 4% per annum, and I don't think either of those is going to happen, but if they do, I'll switch to your side and think the Fed should be moving faster.
Professor, it's widely expected that the Fed will announce the end of its taper at the October meeting. Two questions for you. One, do you agree with that? Is that part of your consensus? And two,
sure.
How much of that is factored into the market, if any at all?
I think it's 100% factored into the market, and I'll be shocked if it doesn't happen. Something really unusual. The Fed has gone as close as it can to promising that it ends in October. It doesn't quite promise, but it would feel it was reneging on a near promise if it didn't end it in October. So I'm pretty confident it will end in October. That is, the announcement of the end will come at the October meeting, and I think that's completely factored into the markets.
Two quick questions for you. Are you worried about inflation, number one? Number two, we've been debating this week whether the Fed's exit from the stimulus policies can or necessarily will end badly, or will it end well? What do you think?
I think it will end well, but there's no total guarantee on that. It is true, as critics say, that the Fed is about to enter uncharted waters. You could say it's in uncharted waters now, but it's really going to enter uncharted waters. It has a sensible plan for exit. It has the ability to execute that plan. I personally don't think the job is all that tough, although a lot of people think it's tougher than I do. So I expect it to be largely successful. Now, that doesn't mean perfection will be achieved.
Inflation
if you look at
worry?
the Fed's targets,
Inflation will worry for you?
I was going to say, if you look at the Fed's target, they want 2% inflation and they want 5.6 or so percent unemployment. Will they hit those exact numbers? I doubt it.
Right.
That's just asking for too much. Inflation could come out a little higher in the end. It could come out lower also.
Right.
But there is a possibility that inflation comes out a bit higher at the end.
Professor, thank you as always for being with us. Alan Blinder of Princeton.
You're welcome.